So, a major clue about the future of the US dollar has just popped up, and honestly, it's being almost completely ignored by Western media. While everyone in Washington is saying the dollar's dominance is secure, China and the BRICS nations, well, they're quietly building something new. We're going to break down what's actually happening and why the year 2026 could be a really, really big deal. You've probably heard this rumor floating around for years, right? The idea that the BRICS nations, that's Brazil, Russia, India, China, and South Africa, are about to drop a brand new single currency, one that's backed by gold, ready to go head-to-head with the dollar. It's a really exciting idea, and it's why a lot of people think Russia and China have been hoarding gold. But here's the reality check. That rumor? It's pretty much dead. Instead, what's actually taking shape is something way more practical, way more strategic, and frankly, a much bigger long-term challenge to America's financial power. Yeah, the real plan is so much more grounded. Forget about some shiny new speculative asset. The BRICS nations are building a system based on actual trade and real infrastructure. They're pushing a currency model that's backed by something tangible, a nation's real, honest-to-goodness productivity. And this idea is perfectly summed up in a statement that's been attributed to President Xi Jinping. The whole argument is that the yuan's real strength doesn't come from Wall Street or financial markets, but from China's incredible industrial might. And that confidence, well, it sets up a huge clash of economic philosophies. And that brings us right to the heart of the conflict. We're talking about two completely different models of what actually gives money its value. You've got the finance model, which the US is famous for, and then you've got the production model, which China is championing. Think about it like this. The US model gets its power from global finance, Wall Street, treasury bonds, a whole system that's grown way, way bigger than the real economy it's supposed to support. China's model is the complete opposite. Beijing's whole philosophy is that a strong currency comes from making real stuff. We're talking goods, infrastructure, and just raw industrial power. And this really tells you something staggering about the US model. A mind-blowing 80% of all US dollars that exist today were created in just 22 months. That was between January 2020 and October 2021. I mean, that level of money printing is a key part of the financial model, but it definitely makes you ask some serious questions about its long-term value. Now, to get why China is so confident, you just have to look at manufacturing. Today, China makes up nearly 30% of all global output. That means it produces more industrial goods than the US, Europe, and Japan combined. It's the king of supply chains for everything from electric cars to high-speed trains. This is that productive power they're betting everything on. Okay, so let's just be crystal clear on what we're talking about. A productivity-backed currency is one where its value isn't just based on what the market feels like that day or how much a government prints. No, its value is tied to the real, tangible things a nation produces. And that right there, that's the alternative model that the BRICS and a lot of the developing world are finding more and more attractive. Now, I know this might all sound a bit theoretical, right? But this isn't just an idea on a whiteboard. It is already happening. So let's jump into a real-world example to see exactly how this blueprint is playing out and what it means for countries who are looking for a way out of the dollar system. And our case study is Kenya. The government there made a huge decision that barely made a peep in the Western news. They successfully converted billions of dollars worth of railway debt from US dollars into Chinese yuan. So here's how it worked. For years, Kenya was really struggling with its dollar-based loans. See, every single time the US Federal Reserve raised interest rates, the dollar got stronger, and that meant Kenya's debt payments got more and more expensive. It's a tough spot. So what they do? They made the switch to the Chinese yuan. And the results? They were immediate, and they were dramatic. Under the US dollar loan, Kenya was paying an interest rate of 6.37%. After they switched it over to the Chinese yuan, that rate dropped to a fixed 3%. Just like that. I mean, that single move is saving the country hundreds of millions of dollars every single year. And this is why it matters so much. This gives countries like Kenya the freedom to actually build things and invest in their economies without constantly being terrified that some decision made thousands of miles away in Washington could suddenly make their debt completely unaffordable. It is literally a path to escape what many call the dollar trap. So what's the long-term game here? Because this isn't just about offering a better loan deal. No, it's about a self-reinforcing strategic cycle, one that's designed to completely reshape global finance over the next few decades. Let's walk through the steps. It's actually a brilliant 6-step process. Okay, step 1. China gives out loans directly in its own currency, the yuan. Step 2, those loans come with a condition. You have to use Chinese companies to do the building. Step 3, those builders, well, they have to buy all their equipment and materials from Chinese suppliers. You see where this is going. Step 4, this immediately creates a huge stimulus for China's own industries. Step 5, the partner country is now tied to Chinese tech and trade standards, which creates dependency. And the final step, step 6, all future loan payments have to be made in yuan, which systematically forces the currency to be used more and more around the world. It is a perfect closed loop. So if you take away 3 things from all this, let it be these. First, this whole model completely bypasses the US-controlled SWIFT payment system. Second, it locks countries into economic relationships that last for decades. And third, it methodically expands the global use of China's currency for real trade, not just for financial speculation. So what we're watching here is a quiet but incredibly fundamental shift. This isn't some big dramatic showdown over a new currency. It's a slow, methodical construction of an entirely alternative system. And while there isn't some official plan for 2026, a lot of analysts see it as a symbolic target year, the year this parallel system will be strong enough to be a true alternative. So the question isn't just about whether this is the end of the dollar's dominance, but what the rise of this new financial world is going to mean for every single one of us.